Hey everyone, today we talk about corporate venture building. Welcome to Invincible Innovation Live. So I'm so glad that you're here. I'm Mazor Kario, innovation and value creation expert, and I'll be your host. And today with me, I have a very special guest, Julian. Hi,
Hi,
Julian.
Eddie. How are you? How are you?
Great, great. I'm so happy that you're here, Julian Ritter, associate partner at Stryber. And I'm so happy that you came, and I'm sure it's going to be really interesting.
Well, I hope so. Thank you very much for having me.
Sure. We're live on LinkedIn, YouTube, and Facebook, and you're much invited to join the discussion and ask questions, and we'd love to hear what you think. And let's start. It seems that all companies need to innovate. What are the biggest obstacles, as you see it, to innovation?
Yeah, and there are a few, and maybe the first one is something that you implicitly assume in your question that all companies appreciate that they need to innovate. I speak to quite a few companies who aren't necessarily convinced by that, and it might be true for some industries and for some companies, but in the whole, I of course agree with you that most companies, if not all, need to innovate or would do much better to innovate, right? But what are the obstacles beyond kind of the recognition of the fact that that's a problem and that's something that they should all be doing or looking at? It's a few things, right? And I think the kind of one thing to look at with that question is Clayton Christensen, who wrote the Innovator's Dilemma about 25 years ago now, and who kind of wrote the manifesto of all the things that are the obstacles for why corporates don't innovate. But one of the most interesting things I think he said is that kind of the decision-making processes, the budget allocation processes, the management processes that make corporates so successful and as successful as they are the very processes that make it impossible for disruptive technologies, for disruptive innovations to take off in that same environment, in that same culture, right? It's just two completely different worlds, and it works in a completely different way, so that only because you're good at the one thing doesn't necessarily make you good at the other thing at innovation. On the very contrary, it actually probably makes you bad at innovation. Right? And this kind of leads to maybe some points we'll get on later about how particular things are really important at corporate innovation. And one of them is kind of setting the governance structure up in the right way. So making sure that the way you manage your innovation unit is completely different and removed from the way you manage your core business, right? But we might get into that a little bit later. I think the other thing that the other kind of big obstacle for why companies might fail to innovate is short-termism generally, right? And usually the bigger the company, and of course, especially if a company is listed, the more focus there generally is on short-term developments, short-term returns, quarterly earnings, quarterly reporting, right? And that kind of goes hand in hand with the tenure of most CEOs at large listed companies that are relatively short compared to the timeframes that you need in order to drive significant innovation forward, right? If you think about kind of the time scales that a proper innovation program needs to be successful, that is 5, 7, maybe 10 years even. And that's not something that maybe might be super appealing to a CEO who, even when she starts, knows that they're probably not going to be around for 10 years. If things go well, they're going to be around for 5 years. Most likely they're going to be around for 3 or 4 years. So why start something today that's only going to pay dividends in 10 years, right? But there is actually something in there. We recently published a study, an empirical study, looking at that exact question, like how quickly does innovation pay off? And we looked at 1,800 listed companies in the US and Europe, and looked at what kind of impact long-term innovation program have on shareholder returns. And actually what we find is quite interesting. We found, I think, 3 things that are very interesting. The first one maybe isn't so surprising, is that most companies don't innovate significantly. The second thing we found is that those companies that do innovate over the long-term horizon, over say a period of 10 years, outperform those that don't quite significantly on the stock market over those 10-year periods. And both of those things are maybe not the most surprising one, but the last thing we found is very surprising and goes towards that short-termism point, was that the companies that really ran those successful innovation programs over the course of 10 years, and where you could only see really the impact of the innovation program 10 years after they started it, already very early on into those those 10 years, you could see that the stock market appreciated those companies much more, and they outperformed those that didn't innovate over the long term, even though the impact couldn't yet be seen, even in the first 3 years on the stock market. So that is actually something that might be a little bit of a wake-up call to CEOs to say, hey, even if I start a long-term innovation program today, and even if that program hasn't paid all the dividends, doesn't show up on the balance sheet, on the P&L yet, when my 10 years over, the stock market will have still appreciated what I've done, and we can see that in the stock market returns.
Yeah, but what you're saying, I think, is like the seed of what we call innovation theater. So they want the stock market to appreciate what they're supposed to do, but they're not really doing it. They just want others to see that this is like the PR that they're doing for themselves, right? Don't you think it's related to that?
So sometimes there might be a PR angle to it. I mean, in the numbers that we looked at, it was very much what companies drive serious innovation over a 10-year period. And those are the companies like, and I'm just giving some examples of the study, those are companies like Amazon, who create Amazon Web Services. They're great at e-commerce, but they say, this is not enough for us. We want to create Amazon Web Services that now make up significant part of the revenues and even a larger part of the profits, right? And this wasn't, yes, Amazon does a lot of PR around that. And Amazon applies a lot of tactics that are very different to how normal businesses would do it. They do press releases even before things have been kicked off, and kind of put themselves in a situation where they sometimes overpromise on what they can deliver, right? But still, they then deliver on a lot of things, and they create significant and substantial innovation, right? So
yeah, but Amazon is the exception, I would say. It's like they're not unusual. Most people will not do what Amazon is doing. But many of the companies who would say, yeah, we're moving to this direction and we have so many new potential options in the future, and can they really deliver what they're promising? I don't know. Maybe they do believe that they will, but in many cases they don't.
But so I completely agree with you that Amazon is the exception, but should it be the exception? Shouldn't more companies try and strive to be like Amazon, right? And that comes with costs, because Amazon hasn't delivered substantial profits for much of their history, right? They reinvested all of their profits. That's not what the average company does. Any company could invest way more in any profitable company could invest way more in innovation, but they don't, and they don't try to be like Amazon. Should they be to try to be like Amazon? Yes. And just to add to your point, yes, Amazon is the exception, but we've seen, coming out of our study, we've seen companies that are actually very good at that, where you wouldn't expect them to be. So there's a few German, like large Mittelstand companies, machine manufacturers, where you wouldn't think this is what they're doing. You wouldn't think they're doing the Amazon model, but they've exactly done that in some different ways to what Amazon does it, and more kind of through an M&A route rather than a venture building route, the way Amazon often does it. But there are companies that don't fit the kind of the perfect image of Amazon, and still are good at innovating for the long term.
Yeah, I think that I just heard that Jeff Bezos, when he just started, when they were only a bookstore, a small bookstore, he said that it's all for the long run. He's always looking like to the long run and not to the short run. And you see it all through his, I think 23 years. Now it's his last year, I think, in Amazon this year, if I'm not mistaken.
Yeah.
And you see that is going. But, going back to the beginning, you said that there are so many companies who are sure that they don't need to innovate. So I would love to hear who is so sure of himself that would say, I don't need it at all. At all.
Yeah, and this is companies across, I would say quite a few industries, and of course, there's this Aristotle quote, right, that goes something. How does it go? I'm going to completely butcher that here, but it goes something along the lines of, "Who the gods want to destroy, they send 40 years of good fortune," or something like that, right? And this is kind of the story. If you're a very successful company, of course you're gonna think you can continue doing what you have done, and you'll just be fine, even though there's many examples of companies where that hasn't been the case. And as a matter of fact, there's a lot of data that suggests that kind of the lifespan for business models is getting ever shorter, right? If you look, for example, at the average lifespan on companies on the S&P 500, 40 years ago, that was 40 years. Today, that's 20 years. In 5 years' time, it's expected to be 15 years, right? This should be an eye-opener.
After COVID, I think it's already 15 years as I see it, but it accelerated everything. And I think that this is another aspect of what's going on to be in this business impacting what's going on right now in the world in general, right?
No, for sure.
Yeah. So how could corporates create sustainable growth if they're so not willing to invest again in themselves to see the long run, to change the way that they're doing things? So how could they really create something which is sustainable for them?
If they're not willing to invest, they can't. I think that's the short
That's
answer.
A good thing. You should be willing.
You should be willing to invest. And I think the kind of way it starts is that recognition that even if you have a very successful business model going for you, all business models go through kind of the normal business model life cycles, right? And all business models start with an idea and growth and inception, and then at some point you get to maturity, but at some point you always will face decline, and that has happened to basically every business model that we've seen. And there's of course a few exceptions, right? But generally speaking, that's what happens, and those life cycles get shorter. So as a company, you need to appreciate that, and you need to kind of think of yourself maybe as more than just one business model. You need to think of yourself as a portfolio of business models that start at different points in time, and that you have to reinvent as you go along, or introduce new ones, right? So that's really at the root of it. And then when you think about what you can do to introduce new business models and kind of keep reinventing yourself as a company, that's when you land at a few options that you have in kind of your toolbox, in your innovation toolbox, right? And we think the most promising ones that you can leverage to really create a significant impact, significant operational impact, really create new business models that you depend on are M&A on the one hand, and corporate venture building, which is what we do at Stryber.
Yeah. So how would you say, like, if they're thinking about, we could buy maybe a startup, or we could start a venture within, what would be the thing that you would tell them that they would say, okay, we'll take you. You're a better option for us?
So I probably wouldn't make a pitch to anyone to say that venture building is the better option. If there's the right target out there for you at the right price that strategically fits kind of with what you want to do, that is going to create significant upside for you in terms of revenues, EBITDA in the long term, M&A is a great option. And sometimes, or most of the times, I would say even the preferred option. The problem is the availability of targets and the cost of targets often, right? You don't necessarily find what you need, what you want, what aligns perfectly with your vision, with your strategic goals, with the search fields you're active in. And then even if you do, getting that for a price that is acceptable is very much a tricky one, right? And then venture building is the best alternative, because with venture building, you can build those businesses from scratch. It's usually cheaper than the M&A route, and it's available to basically everyone, right? Yes, you need a significant budget behind it, and you need significant commitment behind it, but it is something that is available for everyone. Everyone can do it, and the upside to venture building really is that you have a lot of flexibility in terms of what kind of models you want to build out, what kind of models you want to invest in, and you have full control over killing projects that don't deliver as they're supposed to, and focusing and doubling down on the ones that you find most promising.
But wouldn't you say that when you're purchasing a startup and you're doing this M&A, in many cases they don't succeed because they think that they buy a solution, and actually the people are trying to, at the beginning they want to join to your big corporates, and afterwards they are leaving because you cannot really give them what they want, and you cannot really grow it within your current system and organization. And in many cases, these M&As are not as successful as they expected them to be. And sometimes it's disappointing for them.
No, and it depends very much on the goals, and it depends on setting the right expectations, right? So M&A M&A sometimes has the goal of saying, look, we want to buy this young startup to become more innovative as a company and to get their culture assimilated to ours and to make everyone here at our company more innovative. That it usually doesn't work like that. If you buy a startup, especially if it's relatively young still, what you should do is probably keep it relatively separate from your core organization, let it grow its own course. Yes, leverage the assets that you can leverage out of the core organization to give that startup or that venture an advantage that it wouldn't have had it continued on its own. But you can't expect the startup to change kind of the overall culture of your company. If that's the goal, it's probably in many cases not the right way of going about it. Right? And yes, the other side of the coin is also a tricky one. How do you make the startup employees? How do you keep them happy in kind of where they are and so on, right? And this is a tricky one also, and that depends a lot on expectations management. And yes, there are a lot of examples where M&A transactions weren't successful, but there's also examples of companies that are doing it very successfully. And yes, of course, kind of the usual innovative suspects are amongst them, the Amazons and the Facebooks and so on. But there's also companies that have proven themselves to be very good at that, where you wouldn't have necessarily expected it. And Walmart is one of them, right? Walmart has actually managed to reposition, reinvent the whole organization in some way by the many acquisitions they've done and by the good job they've done integrating them to the right extent at the right time. So yes, obviously it doesn't always work, and there's a lot of things that need to be considered before making acquisitions, but it can be a very promising route as well.
So what is the most important element of venture building?
I think there's a few very important elements to venture building. And the first one is really the one that we talked about or touched upon at the top, the recognition that only because I, as a big established corporate, am good at the game that I'm currently playing, that doesn't make me in any way good at the game of innovating and coming up with new business models, and B, launching and growing those business models, right? And that recognition needs to lie at the core of everything you're doing on the venture building side, and that leads to governance being a very, very important element of making venture building a success, i.e., setting up that venture building unit the right way, making sure it gets enough budget, it gets enough senior leadership attention, ideally CEO attention, and making sure that the management practices that are applied within that unit are very different from how the core business is run. That means obviously completely different attitude to risk taking, at least on a project level, completely different time horizons, completely different measurement of what success means, right? Success in new business models isn't, how much profit have we made in the first 6 months, in the first year? The kind of business models that deliver profit in the first 6 months are usually not the type of business models that will really drive incredible scale and revenues that make a difference to billion-dollar companies in 5-6 years down the line, right? Appreciating that and understanding that and safeguarding the venture building unit from the tendencies of a core organization through the right corporate governance setup is definitely one of the very, very important elements in how you want to set up your corporate venture building unit. And then the other thing is really a lot of the lessons that you get from startup building and from entrepreneurship, right? And startup building is much less, and this is something that Eric Ries says in his Lean Startup, right? It's much less a process of creativity and we all need to be trailblazers and very creative minds. No, it's very process driven, and I think Eric Ries says something along the lines of, it's the boring stuff that matters when you build a startup, right? It's the processes, it's the thinking about how to go about it very methodologically, and optimizing not for what Eric Ries terms kind of what does he call them? Vanity metrics. So quick revenues, quick profits. No, optimizing for learning and understanding the market, understanding the customer, and building the basis for building something that is really huge, right? So processes is a big one. And then the last one is really thinking about venture building in a portfolio approach. So being aware that, again, and you get these learnings from the startup world and from the VC world, you will never be able to just pick the winner and invest and build up one business and invest in one startup and that solves all your problems. That is not how it works. Even the best VC funds write off most of their investments because the investments they make turn out to be the wrong ones. And this is the best VC funds, right? We're not even talking about we're talking about the average VC funds here. And as a corporate, you need to just be aware that you can never solve for, oh, I only want to build winners. That is never going to happen. If you build a portfolio, if you start with 10 startups, 8 of them are most likely going to fail, and 2 of them are ideally going to pay more than the whole portfolio back, so to say, right? And this is this goes to some of the misunderstandings, a lot of the misunderstandings around startups in general, right? And I think one of the really interesting metrics when looking at later startup success is kind of at the seed stages is how different opinions are about the future success of a particular venture, right? The most successful startups in the long term are often those where investors really couldn't agree, and some investors really thought this was a completely dumb idea, it's never going to work, and others were really taken by it. And that kind of culture of accepting that there is going to be a lot of failure along the way on a project level, not on a portfolio level, but on a project level. And that is something that kind of, if you want to drive successful venture building, needs to be instilled in the leadership from day one.
But you mentioned 2 things. First, they need to be humble enough to say that we cannot do it as we've done till now. So we're successful in that, but not in doing another thing, which is venture building. That's one thing. And second one is thinking more like a VC, more like taking the stakes, thinking about how risky is everything. And it's like a different way of thinking. It's like betting bets, and one of them will work, which is very different than the usual C-level way of thinking. So how would they really manage? They are still there. They're still managing it. So how do you get these 2 things, which is like being risky, or most of them are risk averse, so more risky, and more humble, which is like, I think, not a common thing for a C-level management, right?
Yeah.
as I know them, maybe just in Israel.
No, I think that's probably, and I think most CEOs would agree with your assessment of that, right? I think, to be honest, that the point around humbleness, that's probably an easier one, and maybe COVID has even helped with that, right? I think more and more companies and leadership of companies appreciate that innovation has to be on top of their agenda, and not in the kind of innovation theater way that you alluded to earlier, but like in a serious way, and seriously approaching innovation as something that must be a key priority for years to come. So I'm not, generally speaking, if you look at the state of things, I'm not too worried about the humbleness point. I'm more worried about the kind of attitudes towards risk. And the point that, and you called it bets just now, which is true, right? On a like project level, these are bets, but calling it bets is not going to go down too well with your average CEO or CFO, right?
Yeah, of course.
But this is, in some ways, this is a kind of short-sighted way of thinking about risks, right? Because first of all, the one thing you have to appreciate is, yes, this is of course risky. Anything we do in innovation is risky, but we can be very good at managing those risks on a portfolio level. We can also be good at trying to be smart about managing risks on a project level, but you'll never be able to eliminate the risk. And as a matter of fact, you don't want to eliminate the risk, because only with significant risk can you ever get high or significant rewards, right? But even if you ignore that, the risk of doing nothing is usually much higher than the risk of doing something. And it's the kind of risk that is a bit easier to swallow, because doing nothing is, no one's going to point the finger at you directly and say, on this day you did something wrong because you didn't initiate the innovation program. And it's always the case that you can say, I can wait another quarter, I can wait another quarter. No one's really going to be mad at you for that. And you might be afraid that people are mad at you if you build something that then fails, right? And this is just this is relatively basic psychology, and this is the stuff Kahneman partly talks about as well. But the risk point is really, this is the important one, and this is the one that is tricky about the discussion. But they're kind of making the key stakeholders see that the risk of doing nothing is actually much larger than the risk of taking a few bets that might fail. And if you're smart about the way you take those bets, and if you take enough bets and are smart enough about also cutting down on the bets that don't work and being very happy to pull out of things very quickly when you get any sort of indication that this is not going the way you wanted, and not being too married to an idea that you've had and that you've fallen in love with, and just moving on to the next thing and really thinking about the success on a portfolio level only, not on a project level. That makes it, I think, easier to accept risk in that way and in that form.
Yeah, I think that I totally agree to what you're saying about if I'm doing it, it's like I took a decision. If I'm not doing anything, I didn't do anything. There is no decision. But I think it's related to the fact that people find it really hard to change, especially when there are so many unknowns. So nobody could promise you anything when you're starting this kind of a journey as an organization. And just thinking differently and trying things differently and growing your mind into being like open-minded to a new thing needs your energy, and you need to stand up to resistance in many cases, right? I guess that you will not be as welcomed as thinking about a new strategy of doing more money in a different market as you've done till now, right? And I think that it demands from you to be a bit different from others in the C-level, in the management, wherever you are. And when you're different, it's risky for you to think differently and to be different, and people don't like it.
No. I completely agree with you, right? And it's no CEO has ever been fired because they hired McKinsey or BCG or Bain to run kind of the standard strategy project, right? They're doing what they've always done, and they're doing something with kind of a general stamp of approval if this is something that works. You're not going to make any kind of short-term mistakes with that, right? If you want to be a bit more brave, that's different. And you will be in a position where people point the finger at you and say, "What did you do that? Like, this was a mistake." And that's I guess a problem, a general problem of how we kind of think about risks and think about the outcome of risky projects, in that we only ever judge them by the outcome and don't judge them by kind of the possibilities or the realms of possibilities and the decision at the point when it was made, right? But generally speaking, yeah, you're right. What every company needs is a very positive leader that is willing to take certain risks and not just hide behind what's always been done. Yeah.
Yeah, I think it's related to culture too, because I talked to an entrepreneur from Germany. You know it like much better than me, right? And he said that he did some kind of like a really successful startup, and then he needed to do something financially with banks. I don't know, like getting lots of loans. I don't remember exactly, but in the end, he couldn't pull it off like till the end. And it was very successful, but it didn't work out as he wanted. And he says that the price for failing, as they see it, it's a failure for them. I don't see it as a failure, but many of the people that work with him saw it as a failure. And he said that the price was so substantial, like really, like for him, it was like people stopped talking to him. He couldn't like find a new position. It was like totally, you shouldn't do it. And once you pay this kind of price, and everybody knows that this is the usual price, you will not be willing to try it all again. And you see less entrepreneur, less people taking risks, less people being brave, especially if you're in an organization, and then you're really paying a very high price for it.
No. And this is interesting. I mean, it is indeed a cultural point. And this is probably the reason why most unicorns these days don't come out of Germany, right? And don't even come out of Europe. They come out of the US a lot, where if you started a startup and you failed, good on you. You've tried. Well done. In Germany, you're a loser.
Yeah, you use this word, but you're right. Right.
And that's probably not the right way of thinking about it. No.
Yeah, I think that when we're thinking about what is really losing and what is really winning, it seems that these days the fact that you're trying and learning is not less important than the fact that you've done things in the past and you have the knowledge, and then it's much easier for you to do again another win. and what you learn is things that you didn't know before, right? Because you learned a new thing. And it always reminds me of what Thomas Edison said. It's not that I failed, I found 10,000 ways that doesn't work. So it's like, it's exactly that. So if you're failing, I guess that means that next time you will be much better. And many of the entrepreneurs who are successful in building unicorns, it's not their first venture. It's not their first startup, right? So, so in order to get better, you need to fail and learn. And maybe in your third startup, it will be a unicorn. Most of the times it's not your first. It could be, but most of the time it's not your first one. And it's another way of seeing long term and seeing life. That for the short run, you could be a manager within a company that is doing much, like you have the salary, you have the all the respect that you get to be there, but you're not learning as much if you would have been an entrepreneur, taking your knowledge from all these years and doing something different. And therefore, it's really hard I know that Europe is really struggling to find these people and to make them grow. And many of them trying to open these labs. It could be like from the government, it could be from within companies, it could be in industries, in academia. They're trying to do that. And it's so much harder for them just to have these kinds of minds and creativity and open-mindedness and bravery, even willing to take the risk. It's hard when you need to pay this loser, here stamp on you when you're not doing.
Absolutely.
So how?
Absolutely.
Yeah. So I'm curious to see when more countries in Europe than I do for sure. Do you see a big difference when you're coming? Right now, you're talking to me from London. So do you see a difference when you're talking to people in London than in Germany?
I think so. I think London is probably somewhere, or the UK, generally speaking, is somewhere between the US and Germany on that scale of how much one is appreciated for trying versus how much one is ostracized for failing. Right? It's somewhere in between, but it's definitely on neither end of the extremes. I don't know much about the kind of the culture around failure in other parts of Europe, to be honest. But I think the UK is quite firmly in the middle, as it is in quite a few things between the US and Germany or Europe.
Yeah. So let's go back to what we talked about, the COVID crisis. So how do you see, when you talk to these people in corporates, how do you see corporate innovation affected by the COVID crisis?
So I think it's a mixed bag, but I think overall probably, and I feel bad attaching anything positive to this horrible pandemic, but overall it's probably been a wake-up call for a lot of corporates that put innovation now higher on the agenda than it was before, and not only the kind of corporates themselves, but also investors. I think there have been quite a few interesting BCG studies over the last year about investor sentiment and how investors feel about prioritizing the long term over the short term now and investing in innovation now, rather than saving money. And those have been thoroughly positive from the investor side in terms of let's think about the long term, let's think about innovation and so on, which hadn't been the case before, and which is quite novel, because you generally would think of investors as quite short-termist. I think, of course, some companies are just fighting for survival now, and for some companies, budgets have been slashed, and I know a few organizations where the whole innovation teams have basically been cut. But I think overall and mostly, in the long term, this will have a positive effect on the importance of innovation to corporates.
Okay, we're almost done. I have my last question. So what is the most surprising thing that you learned about innovation from your years of experience?
I think there's maybe, let me reiterate a few of the things I said earlier. I think one of the things is really that finding that came out of our study that I mentioned, that actually even long-term innovation projects that don't show up on the P&L within a couple of years, but are really the long-term projects where you invest, and then only reap the benefits years later. investors appreciate those approaches, and stock market returns show that even early on in those long-term journeys, that is something that stock markets appreciate, and your stock market performance will reflect that. So the myth that corporate innovation has to fail because of the short-termism of companies is actually not quite there. That might often be the reason, but it doesn't have to be the reason, because actually the stock market appreciates long-term innovation projects more than one thinks. The other thing maybe is just the importance of governance, right? Getting governance structure right is probably the most fundamental and most important thing if you think about successful corporate innovation, especially if you think about venture building, if you think about doing something that really doesn't come natural to long-established organizations, and shielding those innovation units from the rest of the organization in the right way, and managing it in the right way, is one of the biggest success factors. And I think I'd underestimated the importance of that a little bit before I entered the industry.
Sounds really interesting. So before we finish here, where would people find you? Where can they hear more about you and Stryber?
LinkedIn is probably best. Everyone can find me on LinkedIn, Julian Ritter, like Ritter Sport Chocolate, if anyone knows that, Ritter.
Yeah, that's a good chocolate. Do you have any connection to the chocolate?
Unfortunately not. No. Unfortunately not. Maybe I'll have to reach out to them. Maybe they'll one day make me a member of their family, but no, none so far. Other than that, I very much like the chocolate, and it makes it easier for non-native German speakers to understand and remember my name. No, but that's about it. But yeah, LinkedIn is a good channel. Otherwise, you can email me at julian@stryber.com. But LinkedIn is probably best.
I want to thank you for your time. It's been very enjoyable and fun for me, and I'm really happy that we had the opportunity to talk again, Julian, as always.
No, thank you very much. I always enjoy our conversations, and thank you very much for having me.
Sure. And to all of you change makers out there, thank you for joining us. You're so welcome to visit invincibleinnovation.com, and I'll see you next week with another insightful talk. See ya.